Things you can do in 15 minutes. Walk the dog. Make a smoothie. Meditate. Now you can add creating a personalized retirement plan to that list. Schedule your complimentary 15-minute call with Heckman Financial Services today. Text VISIT to 800-454-1184.
Keyword.
That's VISIT to 800-454-1184.
Hi, welcome to our show where we talk about retirement planning. Eric is right here in Silicon Valley, and he has been helping people just like you have remarkable retirements for about 30 years now. His mission is to help you have that retirement of your dreams and to help you retire well. Now, first of all, I want to start off by letting you know about the Wealth Creator Toolbox. This toolbox is something you can get complimentary, and in it includes Eric's book. Of course, he is an author. You know that. Worry Less Wealth. You get the book. And then there's some other educational reports that you can get, all designed to help you understand how you can retire well. So all you have to do is text the word toolbox to 800-454-1184. Toolbox, 800-454-1184. And then always remember you can find us online anytime at wealthcreatorradio.com. And Eric, hello to you.
Hey, Luann. Yeah, no, the toolbox is something I've been working on because we really wanted to put everything kind of in one spot, right? Make it super easy for people to get information. Nowadays, websites are almost too long and convoluted sometimes, right?
I know.
So if you can go one spot and then you can say, hey, yeah, I like this. I want this. I don't care about this, whatever data, So there's stuff about women in finance. There's stuff about markets, stuff about, guaranteed products. There's all sorts of stuff up there. So you can click on what you want. I think it's really just a great way to have some education because I think financial literacy is probably one of the biggest places it's missing from our society, I guess is the best way to put it. Education, everything, right?
Right.
And so the more you know, the more empowered you'll be to make the right decisions and really have a lot better future. And as we like to say, worry less wealth.
Yeah.
Hopefully retire with worry less wealth. So so it's a great toolbox there. So use that. And if anybody wants that, a great new resource we have for people.
And I am excited. Like you said, ways to transform your worries of retirement into confidence. And that's what Eric is here for every single week on our show, Wealth Creator Radio. So I want to just start off with a couple of questions. Just everything going on right now with our economy, with the government. The feds have been raising the rates, right? So we know that it's bad for the borrowers, for the people who are trying to buy homes now, like my kids. Now, your kids probably aren't quite there yet. But, then for the people who are retiring, how is that helping savers? If you're thinking about retirement, interest rates are going up. With retirement in mind, how is that helping them?
Yeah, well, if you're paying attention, it's helping you, right? So it's one of those things where sometimes you have to have some action. Probably one of the biggest changes. In January 22, my online savings account was paying 0.5%.
Oh, my gosh.
By December 22, it was paying 3.3%. And what did I have to do to get that higher rate? Nothing. Mm-hmm. Every single month they were sending me an email saying, here's your new rate, here's your new rate. I have a tiny bit of money at a savings account at the bank just so I'd avoid fees. You know how much that changed? Nothing. It's still 0.01.
What?
So
oh my gosh.
If you've got money at big banks, even a lot of credit unions are still pretty awful. Go to these online banks. They're still FDIC insured. There's, you can just search it online. There's a ton of them. Find one you like, but all you do is you link it to your checking account and you move money back and forth. And, you're not supposed to do it daily and stuff. I mean, this is, for the bigger money and stuff. So it takes usually 2 to 3 days to get the money. But again, if you're trying to pay your whatever, your credit card bill or some big home purchase, you usually know that's coming. So
right. Or like a big car,
not a big deal.
Like a car purchase, right?
Yeah, or something like that. But I mean, that's a huge difference in income. It's real money now. All of a sudden, versus you used to joke like, hey, I can buy half of a lunch now, right? And now you can actually buy real stuff with that interest. So I think that's one of the big ones. The other thing, of course, is what it's done to the bond market. I mean, it's decimated bonds. Bonds were awful in 2022, dropping 13%. And so what does that do for your allocation? Well, if you have one of those target date funds, those funds that say 2020 or 2025 or 2030, you're getting closer to a 60-40 portfolio, meaning 60% stocks and 40% bonds. Well, as the bond markets keeps going down as rates go up, and you get older, they're having you put more in stuff that's going down. So that is not a good way to go. Now, if you're younger, not as big a deal because those things may be 80-90% stocks, so if those, if you're in like a 20-60, I don't know, they have 20-60, they probably do, so so if you're one of these ones like for my kids in the 20s or something, then that's gonna be fine. But if you're close to that age, that year I should say, and getting closer to that, then they're gonna keep putting more and more bonds. And that may not be the great way to go. So there's a lot of new alternative products there that have great rates that can really help you out. I mean, there's, fixed accounts where the principal is guaranteed, but you earn a rate based off the S&P 500. Those have annual caps, meaning you earn up to this limit of double digits now. Those used to be about half of that a year earlier. So, if you can make 0 to 10% without the risk of loss, one of the things you give up is you only can access usually 10% of that money. Okay. For most companies. So you give up a little liquidity for the safety and the higher growth. Wow. I mean, bonds aren't going to appreciate like that.
Right.
And such. So there's a lot of great products out there that have been a monster change, probably the biggest shift I've seen in 30, 40 years, in the financial markets. And of course, I've been doing this for 31 years, but, in terms of how long they've, been done, we haven't had this big a shift for a long time. So, again, that's something where, if you want to get a little bit more information, again, educate yourself, get that toolbox. Again, you can request that by texting the word toolbox to 800-454-1184. Again, you can text or even call and leave a message. So if you want to call and leave a message for Toolbox, or if you want to text it, 800-454-1184, or go online and request it at wealthcreatorradio.com.
And again, this is a complimentary toolbox. And again, it includes the Worry Less Wealth book that Eric has written and lots of educational reports that you can just choose from too. So all for you, complimentary. We just want to, help transform your worries of retirement into confidence. So make sure you get that toolbox, 800-454-1184, text or call. So another thing that, of course, we're seeing in our lives this past year, inflation, prices going up, market volatility. So we've got to have that guaranteed income. Tell us about options for that.
Yeah, well, again, that's like I was talking about earlier, some of these fixed accounts, these are insurance-based accounts that, they can earn some great rates now. And so some of them you can even tie in with, lifetime income options. That way you've got a base of income. So really, if you really think about how you should structure your payouts, you have Social Security, but you most likely don't have a pension, right? So if you don't have that, then everything's based on hope. You hope the market does well. You hope things are doing good. And I don't want to have my clients retire on hope and find out that's not a very good plan. So instead, if you can have some money that's guaranteed, say it's $1,000, $2,000, $3,000, whatever it is per month on top of your Social Security. Well, if that's meeting most of your fixed costs, most of the stuff you have to pay for, your health insurance, your taxes, your property taxes, insurances, other things, all those basic items, food, then you can just really worry about having the market money pay for your fun stuff, right? The big trips you're going on and other things. There's some great new options, but people really need to educate themselves and find out what's out there. So that's something that if you wanted to take advantage of, look at those resources first at the toolbox. Check those out. If you want to set up a time after that, we can definitely talk and help you. But this is probably one of the most critical times, the biggest shifts we've had in the economy in a positive way.
Yes.
So you hear all the bad news. This is a positive. These are some great new options out there, some stuff I haven't seen ever before. So loving it because we have so many more options for our clients. So again, if you want to get that, you can either text the word toolbox or you can just leave a message. Both of them would be 800-454-1184. Again, that number is 800-454-1184. Or you can request it directly online at wealthcreatorradio.com.
This is Wealth Creator Radio with Eric Heckman, and we're not done. We'll be right back with more.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. Take his checklist challenge. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. See if you've got it right. Take the checklist challenge today. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hi, you're listening to Wealth Creator Radio with Eric Heckman. I'm Lou Ann Fulmer. You know, Eric has done this for over 30 years now. And when I say done this, I mean helping people retire. In 2020, Eric, more than half of all Americans were covered by some type of life insurance. So a good number of people see life insurance as a really useful tool to protect their families and their loved ones. But what I want to address today, Eric, is not really do I need life insurance, but rather, do I need life insurance for my retirement?
Yeah, well, life insurance has been always kind of boiled down to two things. Do you owe someone, and do you love someone? So lots of times when you're starting out, it's you owe a bunch on a mortgage, right? So you want to have enough to cover that mortgage in case you're gone and for the rest of your family. Maybe your mortgage is paid down a lot more. The kids are grown, so it's less dependent on you being around. So that's when people start going, oh well, do I still need it? What should I be doing? Well, there is some big changes that happen when somebody passes away during retirement. I mean, if you're a married couple and one of you passes away, you not only lose that smaller of the two Social Security checks, you also flip from being married to single filing on the income taxes. And so I had one client that literally, after his wife died, he lost some of her income, some other stuff. So he made $20,000 less, Oof. But his tax bill was actually $20 more. So it was almost, his tax bill was almost no different. It was almost a dead even, break even type of thing on the taxes. But he made $20,000 less. It's like, well, hold it. How can you make so much less and have the same tax bill? Well, Again, you're no longer married. Now you're single filing, so all those brackets go up way faster. So, that's where sometimes the life insurance can kick in. The other thing, too, is a lot of the modern policies now, finally, in California, it took them a long time, have long-term care benefits. So life insurance may not actually be about you dying. It might be more about you needing care and how to pay for it and not using up all those dollars that your surviving spouse may need for their retirement after you're gone. So it can be a very useful tool for retirement now.
Yeah, I love that life insurance policies can be used for long-term care benefits. So to figure that out, if that's something maybe you might want to use in retirement, what would be some key questions we should ask ourselves?
Well, like I said, of course, how much do you owe, right? So if you've got a lot of debt, a lot of people nowadays, especially with the tax law being so favorable and when we had interest rates so low, it didn't make sense to pay off that 2.5% or 3% mortgage. Now, if you got a newer one, it may, may really make sense to pay it off. So, so that's one of those things. If you owe a lot, you might need to have that life insurance keeps going just because of one person passes away and you lose that Social Security check. Can the remaining income for the surviving spouse still pay for that mortgage? And often it may not be the case. But then also, in terms of just wealth transfer, I mean, the worst tool in the world is IRAs and 401ks to leave behind because, if you leave that to the next generation, your kids have 10 years to blow that money. I mean, literally they have to spend all that money and pay all the taxes on it. So, you don't necessarily want to be doing that for, leaving those types of assets. Whereas if you can leave life insurance where it's tax free, If you do that tax-free money, it's all theirs. They can do whatever they want with it. So, there's a lot of benefits to having that. Again, you have to be able to figure out, how do I pay for it, right? Where does the money come from to fund it, and what type of policy it is? It can't be group insurance that expires when you quit your job. It can't be term insurance that runs out. And so there's some great new options, but people really need to educate themselves and find out what's out there. So that's something that if you wanted to take advantage of, look at those resources first at the toolbox. Check those out. If you want to set up a time after that, we can definitely talk and help you. But this is probably one of the most critical times, the biggest shifts we've had in the economy in a positive way.
Yes.
So you hear all the bad news. This is a positive. These are some great new options out there, some stuff I haven't seen ever before. So loving it, because we have so many more options for our clients. So again, if you want to get that, you can either text the word toolbox or you can just leave a message. Both of them would be 800-454-1184. Again, that number is 800-454-1184. Or you can request it directly online at wealthcreatorradio.com.
Thanks so much for joining us. This is Wealth Creator Radio with Eric Heckman. I'm Lou Ann Fulmer. So we're talking today about key questions that you should ask yourself to try to see whether or not you still need life insurance in retirement. Now, Eric, a lot of people who are trying to retire or who are retiring probably do have life insurance policies already in place. What should they be thinking about?
Well, are the policies that they own, right? So that's one of the big ones. So like I mentioned earlier there, if it's group insurance or term insurance, term is something that literally is good for a term. Mm-hmm. So if it's a 5-year term, guess what? After 5 years, it goes away. If it's 20-year term, it goes away after 20 years. Usually those policies, by the way, say you're paying, $100 a month, most of them I find go up 10 times. So that $100 a month may be $1,000 a month after that. And so that's very brutal. And lots of times, unfortunately, I have these phone calls and discussions with people that will reach out to us and say, hey, I've got this policy, it's expiring, I'm 78, what should I get? It's like, not much, because sadly, a lot of times your health may not be good enough anymore, but also just the cost would be prohibited. That's the hard part is does this make sense for your situation? And so you usually want to have some sort of permanent insurance. You want to have something that's going to be there for the rest of your life. So again, it has to be something that isn't going to run out. If it is a permanent policy and you've had it for a long time, you want to get what they call an in-force illustration, in-force. So meaning the policy is not lapsed, it's in force. And that'll tell you if they run it out from now until age 100, is it going to still be there? Because again, lots of times I have gotten calls with people who have cash value policies that are running out of money in their 80s, and lots of times it was because they saw a policy that was going to earn 7 or 8% every year, and then rates went down to 4%. And that changed a lot of things. It was great for your mortgage, but it really was not good for your life insurance. So these are some things that to be thinking about is how to pay for these. How are you going to keep them going? And then also is it trying to help your surviving spouse more, or is it trying to help the next generation? So there's a lot to be said for when you're doing this planning.
That's what I was going to ask. Are there any other factors we should be thinking about?
Well, the probably the biggest one is the misuse and abuse of life insurance. I would call it, I guess. Some people like to call it the laser fund, or they'll call it LIRP, which is like a life insurance retirement plan, or 7702, which is just a tax code that talks about life insurance. So they'll do anything to call it something that they don't have to use the words life insurance. So that way they can hide it, disguise it. And what are they hiding for? What are they sheltering for? Why are they making up these cutesy terms to not actually say what it is? It reeks of somebody trying to tell you something that's not and trick you into stuff, right? So be careful if anybody's trying to use those types of, goofy terms. Life insurance can be a great tool. If you, especially the overfunded, we've used it a lot for clients where you put extra money in there. You fund it, you try to keep the life insurance part actually small, and you try to overfund it and get a bunch of cash value in there. And it can be a great tool that can actually pay a lot of tax-free retirement income. So, there is definitely a great advantage to doing it. But the problem is you usually have to fund it for at least 5 years, and you usually need like a 10-year timeline before you start touching the income. But I've seen people where they say, oh, yeah, I'm going to start it in 2 years or 3 years. Well, it just doesn't have time to build up enough money and work. And why did somebody talk them into that? Well, because they got paid a lot of money. And sadly, that's the only reason. And so with life insurance can be a really critical tool. It can make really good sense for long-term care protection. It can, make sense for tax-free income. There's a lot of great things, but again, it has to be part of an overall plan. If it's not, then how are you going to know if it's right for you? So, again, with here at Heckman Financial, we've got this great thing where we've built this blueprint to worry less wealth. We typically charge $1,500, but we've been waiving that for radio listeners and podcast listeners. So again, if you want to take advantage of that, we'll set up a first phone call just to find out what your situation is. And then we'll go from there and we'll actually create that blueprint for you that'll tell you where you are in terms of income planning, investment planning, taxes, healthcare, and legacy. And then we'll know what tools are right for you, what tools are wrong, and where you should be taking action and what things you should not be doing. Once you have that data, that knowledge, then it's so much easier to figure out what you should be doing versus just taking what people say. Now we at least have some evidence to say, oh yeah, this makes sense for my situation. So again, if that's something you want to take advantage of, all you have to do is text the word VISIT, 800-454-1184. Again, text the word VISIT, 800-454-1184, or go online to wealthcreatorradio.com.
Eric will explain what IULs are and how they work, if they could make sense for you. That's all coming up next. So stick around for more of Wealth Creator Radio and Eric Heckman.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. Take his checklist challenge. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. See if you've got it right. Take the checklist challenge today. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Hi, we're so glad to have you join us. This is Wealth Creator Radio with Eric Heckman, who is a well-known speaker and author, and he's here to give you guidance for everything that you do to and then all the way through retirement. He wants to help you worry less. We're talking today about questions that you need to ask yourself to try to determine if you still need life insurance in your retirement years. So, Eric, what we're learning today is that because your financial needs are different in retirement, so are your insurance needs, right?
Yeah, certainly. I mean, there's, like we talked about earlier, there's things where, and you're talking about, do you owe money? Do you need to cover a mortgage? Do you have young kids? But then, of course, as you're aging and stuff, you don't have, hopefully, those young kids living at home. Hopefully they've got, at least you kicked them out if they had moved out on their own, right? I got 3 sons, so they better not all end up being at my house forever.
Back at your house, yeah.
Yeah, so, but then, there's other things like long-term care, retirement income, just tax-free growth of money. So there's a lot of other reasons that you might need to have the life insurance there that are very different from when you were buying it, say in your 20s, 30s, or 40s.
One of the life insurance options that we often hear about is that indexed universal life, or IULs. So I want to talk about that. Explain to us how it works, please.
The original policies were kind of more like a 30-year fixed mortgage kind of thing. So that's the easier way to kind of show the differences. So when you're talking about whole life was where you actually invested in that company. So, if you, like I started my career with New York Life. So if you owned a policy in New York Life, you literally owned kind of a little piece of that company, and you were dependent on them for paying you dividends and giving you the money. And then in the 80s, E.F. Hutton, if you remember, when they talk, everybody listens.
Everybody listens, yes.
So if you're old enough to know that commercial, they actually came out with first universal lives. And so these were much more like a variable rate mortgage where things were now, kind of separated out more. With universal life, you have this this cost of insurance that you see, you have the earnings that you see, and it's a lot more visible. But that was in the Jimmy Carter days, the high interest rates. And then once those rates dropped, everybody's like, well, that's not working so good. And then they had variable life, which was in the stock market. But again, you're trying to make this money be more guaranteed and grow. So those had so much fees and costs that, finally everybody realized that indexing was the way to go. And so the big difference here is the universal life part. It means is you see the fees, you see the costs. So everything's kind of broken out so you can really see like how much is the cost of insurance, how much is the cost of running the policy. That's literally every annual statement shown to you, for what all those costs are. But the big difference here is instead of your money getting a set rate from the insurance company or being based on the insurance company's performance, now they're making it off some stock market index. So, of course, like S&P 500 is the main index that most people use. So say if the cap was 10%, what that means is they'll pay you anywhere from 0 to 10% if the stock market does that from usually what they call an annual point to point. So if it was June 1st to June 1st the next year, they'll look back over that year. How did that money do? How did that grow? And then they'll pay you anywhere from 0 to 10%. Now, if the market did 11, 12, 15, 20, whatever, you don't get that. You only get
10%. Yeah.
But 10 on something that's guaranteed is pretty dang good, right? So now what happens if it goes the other direction, right? If it goes negative something, well, the neat thing there is you don't lose a dime. You just earn 0, but now you started over, and guess what? That starting point's a lower starting point. Well, typically after the market drops, it usually will rebound eventually. And so, now that you got locked in that lower number, it's really easy to have a higher percentage gain that next year. Even if the market doesn't come back to where it was, again, that's like a 1-year sprint. It's not a marathon. So you're just looking from year to year to see how your money did. And so, so these can be really good policies to earn some pretty decent money. That's the good part. Obviously has the life insurance aspect too. Don't forget that.
Right.
Right. So, and so typically there's a couple ways that works. One is you have a flat death benefit. So if you started off, say at, a $500,000 death benefit, if you build up $100,000 of cash value, it may still be 500, which means as your cash value grows, you're getting less and less life insurance. The other way is you can do it, your cash value plus your death benefit. And so those kind would be if you had 100,000 of cash value and the death benefit is 500, now it's 6. So, that's one of those things where, again, that's a cost item. If you're buying more insurance, of course, it costs more. So if you're trying to have that death benefit grow, then that may make sense. But if you're trying to get the cash value to grow lots of times you want the life insurance to actually be smaller, which sounds counterintuitive. But basically the government said if you have too much money, because people basically in the 80s were being really abusive of life insurance, they were dumping in tons of money. They dump in like $100,000 into a $5,000 insurance policy at the time that was paying 12%, tax free. Well, that was a pretty good deal. And so, but then the government's like, hold it, if you're dumping $100,000 into a $5,000 policy, this is not life insurance. This is just a tax dodge. So they do have these limits that say, okay, you have to have so much death benefit compared to your cash value. So, again, there's little things, little nuances. What I find is a lot of people who sell these don't tell people these nuances. They don't tell them the pros and cons of how it's designed. And a lot of times they're designing it so they make the most commission for themselves, which, again, is not the thing you want. So you want somebody who's more of a fiduciary advisor, somebody who knows this in and out and can design it for what you're looking for. So, again, that's one of those things that, if you wanted to set up a time to just talk and go over this, see if what some people call the laser fund or life insurance retirement plan or 7702, all these goofy names, it's life insurance, people. It's index universal life insurance. It's, not the super great IUL. It's just a good product, good tool. But again, like everything, it's got its pros and cons. So again, if that's something you want to set up a time and talk, we can go through that and go over that for you to see if it makes sense for your situation. So, if you want to set up a time, all you have to do is text the word VISIT, 800-454-1184. This could be, virtual, on the phone, whatever. But again, text the word VISIT, 800-454-1184. Or you can book directly online at Wealth Creator Radio. wealthcreatorradio.com.
And this is Wealth Creator Radio with Eric Heckman of Heckman Financial. I'm Lou Ann Fulmer. So you kind of have taken us through, we kind of have a good idea of what's good and bad, but I don't know, you want to go into kind of a list of pros and cons of an indexed universal life insurance policy?
Well, like I said, I mean, they can be really great, but what people forget or, conveniently ignore and don't mention much or whatever terms you want to use. I mean, there's one guy who gave up his insurance license so that way he can have a radio show, print books, talk about life insurance, endlessly, index life insurance. But his whole family's licensed, and then they'll sell you the stuff. But since he has no license, he can say whatever he wants and get away with it. So,
interesting.
Yeah, you want to make sure you're, doing the right thing. I mean, I've seen some of their proposals that they had, and I sent it to their compliance at the one company, and they were shocked that they were using these things. And so you got to be careful of how it's being approached. It can be a great tool to build up money, but it takes time. It is not, this is not, some, strike it rich or, meme stock type thing. This is very slow. This is more tortoise than the hare type of thing. So, most of the policies are good after 10 years. You usually need to fund them for at least 5 years, maybe even up to 10. But if you're trying to get money and have great earnings and stuff after 1 or 2 years, the costs are just too much, initially. So the costs get really watered down over time, but there are some upfront costs that happen. And so, again, that's one of those things where it's all about expectations, right? I mean, if you're trying to use a tool that, is not designed. I mean, if you're trying to do 80 miles an hour in a golf cart, good luck, right?
Right.
I mean, you can try all you want. It ain't going to happen. So if you're trying to make this be super high flying, it's not. It's going to be a slow growth type vehicle, but it can be a great tool to build up a lot of tax-free cash and be a really great source to do that. But again, you gotta have somebody who knows what they're doing, not somebody who just sold your friends and then they're going to be out of the business in 6 months or, something like that. Somebody who's a fiduciary-based advisor like we are here at Heckman Financial. So, again, if you want to figure out, hey, what is all this life insurance things about? Should I be doing it? Should I be using it? We'll give you all the real story, and then you can decide, hey, is this for me or not? So again, if you want to set up a time to talk, just text the word visit, 800-454-1184. Again, text the word visit, 800-454-1184, 800-454-1184, or book directly online at wealthcreatorradio.com.
Wealth Creator Radio and Eric Heckman will be right back.
Things you can do in 15 minutes. Walk the dog. Make a smoothie. Meditate. Now you can add creating a personalized retirement plan to that list. Schedule your complimentary 15-minute call with Heckman Financial Services today. Text VISIT to 800-454-1184. Keyword. That's VISIT to 800-454-1184.
Hi, I'm Lou Ann Fulmer here with Eric Heckman, and this is Wealth Creator Radio. Eric is president of Heckman Financial right here in the Silicon Valley area. So there are so many big decisions that you have to weigh as you head into retirement. We always talk about those decisions every week on our show. Today, I want to do something called Retirement Yay or Nay, Eric. And this week's topic will be leaving an inheritance or not.
Sounds good. Yep, let's go for it.
Okay, you know who Daniel Craig is, right? The latest James Bond. Okay. He calls or describes leaving an inheritance quite distasteful. Yeah, and a lot of celebrities are kind of this way, which I think is really funny. They're not wanting to leave their fortune to their heirs. Daniel Craig says, isn't there an old adage that if you die a rich person, you've failed? He says his philosophy is get rid of it or give it away before you go. So I feel it's kind of bad for his kids, I don't know. That's just me. Now, Gene Simmons, on the other hand, KISS bassist, he grew up poor. And so he wants to pass along an appreciation of money to his children. And he does say he's not going to leave them penniless. I don't know. What's your reaction to these wealthy people who say they're not leaving much or anything?
Yeah, well, there's nothing says you have to leave it to your kids, right? So, I mean, I think that's fine. Usually you want to help them out a little bit.
Yeah.
It's pretty hard to spend it all.
That's
so,
true. That's true.
you can't take it with you. So there's going to always be something usually left over. But I think there's something to be said for making sure people earn stuff. The other reality fact is, when they talk about leaving stuff, I mean, they may be living assets to people in their 70s, right? Because if they live to their
That's
90s
right,
or
yeah.
100s, so you better not count on people dying for your retirement plan, because they may not be for a long time.
Yeah.
You might be working really long if you're
That's
waiting
a
for
good-
that.
I want you to please give us, let's just take leaving an inheritance or not and go through the yays and the nays. Okay. So give us the yays of if you want to leave an inheritance to your heirs.
Well, I mean, obviously you have to consider your income needs. So, before you've done that, there's financial aid for college. There's no financial aid for retirement. So yeah, you want to make sure, it's fine to leave it after you've already made sure you've got enough income coming in. Obviously, you want to make sure you have enough healthcare costs covered, because you might end up spending several $100,000 on healthcare costs, and that might be the inheritance. But as long as you've got that taken care of first, you also want to look at the type of taxation for those assets. Is it stocks and real estate that have that tax-free step up in basis, or is it an IRA where they have to blow through the money in 10 years and spend and pay all the taxes? Again, it depends on which asset you're going to use and which asset you're going to leave them. But you want to make sure you understand that part. And then also, are you going to have a plan for that? I mean, are you going to make sure that, how you're going to give that away? I mean, you can give up to $16,000 per person right now. But, you might want to have a trust to protect that money, make sure it doesn't go to that ex-wife or of your son or something like that, or, or lost in a lawsuit or other things like that. And, and things like retirement accounts and all that have a lot of taxation. Again, life insurance is something that can be tax-free, so that's a great tool to leave behind. So definitely nothing wrong with it as long as you've done the planning around it.
Right. Let's go with the nays now. You don't plan to leave an inheritance for your heirs. What would be the nays of that?
Well, I mean, lots of times if you're trying to really get some tax benefits for yourself, the drawback with these is they usually exclude your heirs. There's certain things like if you're over 70 and a half, you can leave money straight from your IRA, your required minimum distributions. You can have that sent straight to a charity, and it's money that you don't have to pay taxes on, and so it's in something where you don't get the write-off, but you just don't pay the tax. So that's a great way to do it. Obviously, you can leave money to a charity. You can do lots of more creative stuff too, like donating stock to them, because then you don't have to turn around and sell the stock and pay the tax. They do it, but they don't pay the tax. So it's a good way to donate your taxes to that charity. But one we've been using a lot of is actually a donor advised fund. Because of the Trump tax laws, that a lot of people can't write off their charitable contributions because they don't have enough to meet the itemized deduction limit. So if you're, say, $5,000 short of itemized deduction, well, maybe you give $5,000 a year away. Well, why don't we donate $25,000 in 1 year by putting it into this one fund? And then from there, those next several years, you just take the money out of that fund and actually donate it to them. And so usually if you're taking stocks or anything else that's gone up a lot, you put that money in there, you get a great upfront write-off, you get to use those deductions, and then it's kind of like a prepaid account, but for charitable giving. So, there's charitable trusts, other things, remainder trusts, other things where you can actually turn around and get income for the rest of your life, and then the charity gets whatever's left over. So, a lot of these tools that give you some great tax benefits, unfortunately, all exclude your heirs. But again, if they're going to have other assets, if there's going to be other things there, most likely they're going to get your house, right? So other things that you're living in. So it can be a great way to go. But again, you want to have a plan. I mean, this all comes down to, how does it fit in with my overall plan? Does this make sense, right? That's what almost all those things, the caveats were, well, how does this affect the rest of your plan? Well, if you don't know the rest of your plan, it's really tough to figure that out. And so if you want to create that blueprint to worry less wealth, we usually charge $1,500, but again, we've been waiving that fee for radio and podcast listeners. So, if you want to take charge of that financial future and figure out what's right for you and what should you be doing, then all we do is we can have that 15 to 30-minute phone call, go over what your situation is, and then we can do that analysis, and we'll go through your income plan, your investment plan, tax, healthcare, and legacy plan. And obviously taxes, legacy kind of go together with a lot of this stuff. Income can go into a lot of this. Investments go into a lot of this. So it's all very interdependent. So again, if it's in a plan, it's really simple to figure out. So if you want to take some time and actually take charge of your financial future, all you got to do is text the word VISIT to 800-454-1184. Again, text the word VISIT, 800-454-1184, 800-454-1184, or book directly online at wealthcreatorradio.com.
And you're listening to Eric Heckman, founder and president at Heckman Financial, where they've been helping clients just like you retire well and finish well, and they would love to help you out as well. I'm Lou Ann Fulmer. Thanks for joining us. This is Wealth Creator Radio. Forbes reports that inheritance trends are shifting for a couple of different reasons. I'll go over these real quick, and then I'm going to get your reaction. So people are living longer. Healthcare expenses have increased by 88% over the last 20 years. The pandemic has caused some people to just say, I'm going to enjoy life now rather than save. And then some baby boomers are choosing to skip the next generation and leave money to their grandkids.
Yeah, definitely. That last one I've seen a lot.
Really?
Oh, yeah. It's like, well, a lot of people are saying, hey, my kids are, making good money. They're making more than I made when I was working and so forth. And so why leave them money? But, I want to make sure that the grandkids have, at least college taken care of, or have the money for their first house and things like that. So, I think that's definitely a big one that's been happening a lot. For sure, like I said, people are living longer. So, if you're counting on that retirement nest egg being inherited down the road, if you inherited at 70 or 75, that might not be super helpful for your retirement, because it might be a little late. And then, of course, like you said, the healthcare part has gotten to be a huge issue, because what used to kill you now slows you down, and there's good and bad to that. So the really bad part is often you're spending 100, 200, 300,000 right before you pass away, and that might have eaten up most of all the assets that were left. Now, lots of times, I had some clients just recently do this with their dad. He was needing care for a long time, and almost all his assets were gone, but they did have the house. So once they sold the house, they did have still money left over. So, but had it been 3 years earlier, it would have been a lot more money. But again, they were able to take care of him in his house, do what he wanted. So it was great. But so I would not count on that as much. I think these trends are going to keep going like that. So again, it's one of these things where you want to have some talks with your family, talks with the kids, figure out what you're doing. Let them know ahead of time. If you're going to give a lot of this away to charity, let them know so they're not counting on it and not surprised and not thinking bad thoughts for the rest of their life about you. All right. It's one of these things where it's awkward. It's always strange, but I've seen so many fights, so many strained relationships, so many relationships that just go bad of siblings after the parents die, and all because of misplaced expectations from each other. And so, sometimes it's just the junk, even sometimes just the sentimental items that somebody left behind. And so, it's one of these things where we have to make sure that it's going the right way and things are set up the right way. So, and people know about it and know what's going on. So if you want to set up a time to talk about this and more and get that blueprint to worry less wealth, well, we'll get that income, investment, tax, healthcare, and legacy plan developed for you. All you have to do, again, no cost, no obligation. We're waiving our fee. All you got to do is text the word VISIT, 800-454-1184. Again, text the word VISIT, 800-454-1184. 800-454-1184, or book directly online at wealthcreatorradio.com.
And Eric Heckman will be right back with the rest of our show.
If something's worth doing, it's worth doing right. There's a particular time of life this phrase couldn't be more appropriate. How can you know you'll live the retirement you've always imagined? After all, life can be so unpredictable. You've worked hard and saved. Watch your accounts go up and down with the market. Your advisor says, don't worry, you'll be fine. But you still don't feel confident. Eric Heckman at Heckman Financial has a checklist to help you find out if you're on the right track for retirement. Take his checklist challenge. If you can check all the boxes with confidence, you may be ready for retirement. If not, Eric can help you address any potential costly mistakes. To get Eric Heckman at Heckman Financial's complimentary checklist, call or text LIST to 800-454-1184. See if you've got it right. Take the checklist challenge today. Call or text LIST to 800-454-1184. Firm offers insurance services. Investment advisory services offered through Heckman Financial and Insurance Services, Inc. Investing involves risk, including the potential loss of principal.
Thanks so much for joining us. This is Wealth Creator Radio with Eric Heckman. Remember, you can text the word toolbox to 800-454-1184 to get this digital toolbox from Eric, including his book and other wonderful educational materials about retirement. Now, Eric, you and I often discuss challenges and risks in retirement, and so I thought we'd bring another story about someone who's experienced some obstacles in retirement. We call it a financial fail. So, Eric, what do you have for us today?
Well, this one's more of a, I guess, compilation is, probably the best way to say it is sometimes people, for whatever reason, they just think they should go for it, or they don't realize how much they're putting in one spot, right? And I have one client that he's like, okay, all I need is like 50,000 more for Bitcoin, and I'll get that house in Pismo Beach and be moving. Well, then of course Bitcoin tanked huge, and that he ain't getting that house anytime soon. And then I had some other clients that said, hey, and at the beginning of 2022, they said, hey, we've got some extra cash. Let's go for it. They must have looked up every high risk tech stock that you could possibly buy. I'd never seen somebody lose money so fast. They had 80% losses on several stocks, and just kind of huge things. And and then same with companies, with people who work at at a certain company, and they'll sit on that company's stock just thinking it's going to always be great, and then it dives down, and then they're getting close to retirement, and now all of a sudden they don't have all that money. And so we all know you're supposed to diversify, but sometimes it doesn't sound fun, right? Especially when something's shooting up a bunch. I've got one client at Apple who we've just always been selling off 10 or 15%, and sometimes we sell off 10 or 15 and it shot back up, so it was great, but sometimes it also went down, and it was good that we did it, right? So you really should never have more than 10% of your overall net worth in any one investment, if it's a stock or Bitcoin or whatever it is, right? And unfortunately people still do that, and you want to have some tools, you want to have some education out there. So again, get that toolbox. We've got a lot of great things about how to find the right balance, how to make sure your money lasts. Those are obviously big ways to not fail. And then you can even read the book, Worry Less Wealth. So again, if you want a copy of that toolbox, all you have to do is text the word toolbox to 800-454-1184. Again, 800-454-1184. Or you can download or link to it directly at wealthcreatorradio.com. That's all for this week's show. Thanks for listening. We'll be back next week.
Information provided during Wealth Creator Radio is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Individuals should thoroughly review the contract for specific details of the product features and costs. Income payments and withdrawals from deferred annuities are generally taxable as ordinary income in the year they are taken. Eric Heckman offers investment advisory services through Heckman Financial and Insurance Services, Inc., a registered investment advisor. Any tax advice given as part of this presentation is not intended to be used and cannot be used by the taxpayer for the purpose of avoiding tax penalties or promoting, marketing, or recommending to another party any matter or transaction addressed herein. The views and opinions expressed in the program are not necessarily those of the radio station or its sponsors, and they should not construe as legal, tax, or investment advice. You should always consult the appropriate advisor before making any financial decision.